All right, I'm Michael Hartzman. Today is Tuesday, July 1st, 2025, and I'm on as always with my partner, Dominic Tavella. Happy second half of 2025. Dom, how are you?
We are officially in the third quarter, Mike. The first half of the year is over and done with. God bless with that one. And all we got to do now is look forward to the second half of the year.
There you go. So speaking of the second quarter ending, let's just jump into that. So the infamous Liberation Day, which was met with much anxiety at the time by the stock market, was April 2nd. So the second day of the second quarter. And based on the early results of the market, if I would have said to you, Dom, there's nothing to worry about. The quarter, the S&P is going to close up 10%, and the Nasdaq is going to close up, let's see, 17 plus percent. Would you have suggested I get my head examined or increase my medication?
And just for clarity, off of the bottom, right? Not for the year. But I mean, we were looking at doom and gloom, right, Mike? In full disclosure, the current administration had announced horrific, I don't think I'm exaggerating when I use that word, Mike, horrific tariffs. And we were yet to understand how, where, when, if they would even be applied. And the markets reacted accordingly. We can say correctly, but accordingly, where I think the bottom was somewhere around April 8th. The S&P was a negative 18% for the year, and the Nasdaq negative 20 plus percent for the year, and clearly reacting to the potentially really negative economic implications, not only for the United States, but the globe. And then throw in there the Middle East war, Iran, Israel attacking each other, and then ultimately the United States coming into the fray itself. And it was pretty negative there for a while, Mike. Pretty negative.
And we'll get into some of that in detail, Dom, but I think you and I agree, well, I know you and I agree, that as financial advisors, our job is to just call balls and strikes and to be umpires and not be biased politically one way or the other. So what we saw in the beginning of the quarter, and you said it appropriately, the messaging was poor. The tariff numbers in some countries were insane. Small businesses, large businesses were miserable. But somewhere along the line, I think the administration, really spearheaded by the Fed mostly, not the Fed, the Treasury Secretary, Scott Bessent, I apologize, really got the messaging right, got the president to tone it down. And then over the next couple of weeks and last few months, you start hearing, hey, you know what? These tariffs raised $60 billion this quarter. So now that we got the messaging right, now that we're talking to some of these countries, maybe they weren't as crazy as we first thought when we heard about them, which might be part of the reason the market has been, I don't want to say euphoric, but it has been, I think, overly optimistic about what happens next.
Yes, there's a lot of thoughts there, Mike. So let me
Yeah, I
let
know.
me
Sorry.
try to address it. No, this is what we're supposed to do is discuss and debate it and maybe agree, maybe not. But the reaction of the markets, and some might call it extreme, but you and I have been doing this for so long, Mike. We've been in this business for so long. We know how markets react, and that is overreact. Like we always use the example of a pendulum. It swings way over to the left, way over to the right, and then eventually it settles somewhere in the middle. Many of the experts will argue that this was one of the strongest V recoveries they've ever seen in their entire history of being in the business, and that's this extreme downward push in the markets, and then almost a mirror image, extreme reaction back up. And maybe you are correct, Mike, and maybe overreaction down and overreaction up. But clearly, the markets looked at this thing as doom and gloom. And then when the tone, or I hate to even use the word clarity, but the tone was a little bit mellowed out. People were like, well, maybe this is not going to be quite as bad as it originally sounded. And the markets, again, I'll use the word reacted accordingly. But maybe extreme on the down and extreme back on the upside, Mike. But it was a pretty harsh reaction downwards. And then we're certainly happy that the rebound's been pretty good, but also harsh on the way back up.
Yeah, and I do look, my glass is half full always, you know that. But I do think the rebound's been overly optimistic for a couple of reasons. One, ideas of a deal have been announced with countries. Frameworks of deals have been announced with countries. I say this every week, I feel. But Dominic, here we are, July 1st. Trump's deadline, July 9th, is 8 days away, 9 days away. There's still no deals announced, right? There's nothing official in my, unless I missed something, that's been officially formalized with any nation. That's number one. Number two, Trump said today, and again, he might back off, that he's not extending the July 9th deadline. So we felt it was impossible to get 90 deals done in 90 days. How are we going to get 90 deals done in 9 days? And number three, inflation has ticked up a little bit. We still don't know the damage that was done in the second quarter, because we've talked about this a lot as well, where small businesses and large businesses have not built up their inventories, have not done their spending, and are waiting to see for these actual deals to be announced so they can make logical business decisions on what things are going to cost. So there's still several unknowns as it relates to tariffs. We're waiting to find out.
So we have a number of headwinds that we're certainly going to encounter over the second half. But, and we joked about this on our last podcast. Boy, if you closed your eyes on January 1st and woke up yesterday, you'd go, oh, it's been a pretty quiet year. A little bit better than a quiet year, right, Mike? The S&P is up 5.6, I think, roughly through the first half.
Yep.
Uh, Usually have the numbers, Mike. So correct me if I'm wrong. The Dow is up a little bit less than 4. The
Yep.
Nasdaq a little bit more than 5. And the really big winners have been foreign stocks up almost 20% for 6 months, the first 6 months, and emerging markets up about 16% for the first 6 months of the year. So if you own foreign stocks and emerging market stocks, by God, you have had a fabulous year. But if you own the S&P 500 or a balanced portfolio, which would have given you a little bit less of a performance, you've had a pretty good first 6 months of the year.
Absolutely. Who wouldn't take 5.65%? And yes, all your numbers were spot on. Who says you don't prepare for this show? All your numbers were perfect. And you know what? It still makes me laugh because we kind of been in recovery mode for probably half of this quarter. And when I tell our clients, you're up year to date, they're still surprised. Like,
They don't believe it,
they don't
Mike.
believe it.
We can joke about that because it's easy to joke when the portfolios, the markets are up for the year. But I'm really kind of bringing this up to your point that we have all these headwinds in front of us. We have all these hurdles that we've had to cross, and yet this market has been remarkably resilient and holding its own, even if we are still all holding our breath.
And I heard an analyst yesterday morning. And I have a really quick drive to work, and I didn't catch his name, but he pointed something out, Dom, which I wanted to bring up tonight, which I felt was really relevant. The stock market has basically been punched in the head 5 years in a row since 2020, and each time it's got back on its feet and gone higher. We had COVID in 2020. We had supply chain shortages in 2021. We had inflation in 2022. All right, that one brought the market to its knees. It finished the year down. That was a rough year. It
That was a
eventually
rough.
rebounded. 23 and 24, we had interest rate shocks. 2025, halfway through, we had tariffs. So I think part of the reason the market has been so resilient is, as you said, not only have we seen it before, our clients have seen it before.
Two quick thoughts on that one, Mike. First is the economy has been amazingly resilient.
Hmm.
And so at the end of the day, it's not always true that the market is a reflection of the economy or vice versa. The economy is a reflection of the market. But clearly, if companies aren't making money, if they're not improving profits, stock prices generally don't go higher, right? They go lower, Mike. So that happened in 2022. But generally speaking, the economy has been relatively resilient. Consumers have been relatively resilient, continuing to spend. Businesses figure it out and adapt and then come back to making money. And as such, the markets react accordingly. So I want to go the glass is half full from that perspective. But the volatility that we're going through at this point, I think, has put consumers and businesses a little bit on their heels, a little bit in reserve. And it's this next quarter, I think, particularly that we have to pay attention to. And I think the volatility is not done, Mike. I think,
Oh my God, I don't think the volatility is done either. And then, and then tonight, the Senate passed, this bill. Okay, I'll say it, the big, beautiful bill. It's got some changes to it, some amendments to it. It's got to go back to Congress, and so that aside, and the fact that the tax cuts are going to stay in place, no matter what math you use, the deficit is going to increase, the debt is going to increase. And that's been another thing, Dom, for years now that consumers, economists, stock market prognosticators, everyone seems to be ignoring. Is there a time that you worry that we just can't keep raising the deficit for one reason or another? When does that bill come due?
well, and play on words, but the big, beautiful bill is due now. And the biggest fight in this bill is how much the argument of the Republican Party was that they were going to finally become fiscally responsible. They were going to control the spending, and therefore, by definition, they were going to control the size of the deficit. God forbid, actually bring the deficit down. It's a big debate whether this bill actually will do that. And certainly, there are pros and cons to the bill itself, but there is no pro and con to, at least in the short run, the deficit will go higher. And then, depending which set of facts you listen to or interpretations that you listen to, the deficit might go lower in the future. But this bill does not seem to address the spending side anywhere near as much as some people had hoped.
Right, right. And then I think the administration's, logic, I don't think the timing of the tariffs rollout and the timing of the bill were an accident. And we were in a meeting a couple of weeks ago when they said this, the revenue raised from the tariffs, which is real revenue, it's real money, will go towards some of the additional spending in the bill.
And in fact, you can argue, many have, that the budget number is directly tied into how much revenue they can raise from these tariffs. So you can argue which comes first, the chicken or the egg, but they expected they would have X amount of billions of dollars in revenue from the tariffs. Forget about, we're going to come back to this discussion who actually pays these tariffs in a second. But the revenue, as you brought up, $60 billion for the last month, that revenue coming into the Treasury was meant to offset some of the higher deficit. So whether they come up with the budget and agree to it and vote on it and sign it into law and or then agree to the tariff number or vice versa. You are entirely correct, Mike. They are intertwined, and it is not an accident. It is not an accident.
And I think the forecast is to land on 10%, kind of the average. China will be more, other countries will be less, but I think the average isn't it 10%, Dom, that they're expecting?
Yeah, I've heard some numbers I'll say that's in the ballpark, maybe the average being maybe slightly higher, 12, 13%, but I think your 10% number is in the ballpark. And the expectations of that, Mike, were that roughly a third of that number would be eaten by the company manufacturing in another country. About a third of it would be eaten by companies here in the United States, and about a third of it being passed on to the consumer. That's conceptually what the thinking was going to be. But the two problems that immediately arise is if U.S. companies eat part of that cost, that reduces company profits. And if company profits go down, what do you think happens to stock prices, Mike?
I think I remember hearing they might go down.
And if a third gets passed on to the consumer, at some point the consumer raises their hand and goes, nope, not doing it, not spending the money. And we have some real life examples already of companies that have raised some of their prices and sales have gone down pretty dramatically. So I think consumers are a little sensitive here, Mike, about spending extra and really sensitive if they know it's about spending it for tariffs.
But Dom, the consumer, and I agree with you, but the consumer has been the gift that keeps on giving. And I think corporate America, the business community has gotten spoiled and they take the attitude, eventually they'll get over it, right? Eventually they'll deal with it and they'll come back to spending money because we're Americans and we're gluttonous and that's what we do.
And again, subject we've touched on prior podcasts, but obviously the upper end consumer has the resources. They're going to do whatever they want to do, right? But we're seeing things like car loans delinquencies go higher, credit card delinquencies go higher. A recent stat we just got this week, Mike, mortgage delinquencies. When was the last time you heard mortgage delinquencies go
Mhm.
higher? Now they were fractional, they were barely a blip, but when was the last time you heard that mortgage delinquencies were going higher? We have a big bill coming due. All the student loan deferments, Mike, that
Mhm.
the prior administration had put on a big pause. That bill's coming due. They're going to restart those payments, and there's a lot of people that had gone a long time without paying those student loan payments, Mike. Now they're going to have to pay them, and or default on them.
I agree with you, right? And I agree that big ticket items in the short run are going to take it on the chin in the short run. But Dominic, a lot of those big ticket items also come with kind of planned obsolescence, whether it's a car or it's a computer. Eventually, the consumer's got to give in, Dom, and they say, I got to bite the bullet. I can't, I can't drive this car anymore. It's a loss leader.
Yeah, and we look at that kind of data because you see the sales or the purchase, if we look at retail sales, really kind of crater, and then all of a sudden they start to pick up, and it's exactly your point, Mike. You know what? I may not want to buy that washing machine, but I gotta buy it, right?
Yeah.
I may not want to replace that car, but I have to replace it. So the all of a sudden the economy starts to tick up, and all of a sudden the employment numbers get better, and the economy re-engages and comes out of that recessionary cycle. It's why many quote unquote experts think we get to a lull in economic growth in the third quarter of this year. We get to something that kind of looks, acts, and smells like stagflation. Economy flattens out, inflation stays relatively high, but then in the fourth quarter we re-engage and the economy becomes stronger and starts to pick up some speed, some steam. So everything you're talking about, Mike, is in the cards. I think it's in front of us.
So let me put you on the spot a little bit. Take you back to last Saturday night. We dropped a 30,000 pound bomb on Iran. We've never since I don't think since the Hiroshima we've dropped a bomb that big anywhere at any time. It may even been bigger than it was a nuclear, but it may have been a bigger bomb than the one we dropped on Hiroshima. What were you
And
thinking
just
Saturday
for the
night?
sake of correction, Mike, they were many of them were dropped, not
Many of
one,
them, many of them, right? They were called MOBs. I'm not a military expert. I know it's a big bomb.
big one.
Saturday night, were you thinking, oh crap, it's going to be a busy Monday morning. We're going to be down 1,000 points. Did you really expect in your wildest dreams last week that the S&P would be up 3.5 and the Nasdaq would be up 4.25?
Look, Mike, I'll point the finger at myself. I wasn't checking the Met score or the Yankee score. I was checking the futures to see how the markets are going to go open up on Monday morning. And frankly, I really expected it to be a brutal, brutal number. And it wasn't. And I'm like, how is this conceivable that you have literally war in the Middle East? You have the US now directly involved in that war by taking military action against another nation. We're not getting into the politics, we're not getting into the
Right,
justification. What we're saying is markets do not react well to that kind of headline. And although the futures were down modestly,
modestly. Yes,
you're like, this makes no sense to me. By the way, the reason why the futures would be down tremendously is that war in that particular spot means that oil gets restricted for the entire world, not just China, not just Europe. Oil prices would have shot up through the roof, and the restriction in oil would have had $100 a barrel oil overnight. And it didn't happen. It was amazing. It didn't happen.
and here's the other crazy part of it, Dom. In this short attention span news cycle we live in, that seems like 6 months ago.
Look, we did get some very quickly some positive news, if you could call it that, primarily by the administration. Hey, this was basically a one-off. We're not sending troops in. It's not going to be an invasion. We're basically sending a message. And then Iran, in their response, and that was the another very, very scary moment. It was a very, very limited, telegraphed response. No U.S. personnel, as far as I know, no one was injured by Iran's response. So again, I think the markets took a big sigh of relief. Hey, this is going to be kind of a one-off, and it's not going to be really all that bad. But nevertheless, Mike, you hit the nail on the head again. I would not have been surprised to see the Dow Jones Industrial Average down 1,000 points, and it was virtually flat.
Yeah, exactly. And and my son Scott asked me, Monday morning, why it's been so quiet. And I think another part of that was I'm going to mispronounce this, I always do. Where you mentioned about the oil is Iran, I think, controls what's it called, the Straits of Hormuz. Did I
Yes,
say that
Straits of
right?
Hormuz, correct. Yeah.
Okay. Oh, finally. And they kept it open, right? So
Well,
I think if they would have closed that and really created that economic disruption, that also would have created more turmoil, I think.
it kept it up in the context that they didn't attack any of the ships going through,
Right.
Mike, and the U.S. Navy was there in force to make sure that didn't happen. But even an attempt to do that, Mike, even an attempt, and by the way, they've never been closed in the history of
Right.
mankind.
Exactly.
But Iran could have made it very difficult. Very could have certainly shot missiles at ships. Some of them could have gotten through. And again, the implication that somewhere between 20 and 30% of the world's oil supplies goes through that body of water. So the idea that even restricting it a little bit would have been horrific, and oil prices would have shot through the roof. So again, we got some relatively good news in the picture, but the idea that these markets didn't react negatively was almost shocking to me. Almost shocking.
And I'm very grateful for that. And I do think, as I said earlier, it is because I think traders, investors, consumers, the storyline may change, but they've seen the idea of this movie before, and I think they've just grown accustomed to this kind of resiliency for the market and to take on these short-term shocks. So why don't we do this, Don? We're bumping up against a break. Why don't we take a quick break now? When we come back, we'll talk about some of the other headwinds, as you mentioned, we might be looking at, and what we think might happen for the second half of 2025. All right, I'm Michael Hartzman, back with my partner Dominic Tavella. So, Dom, you sent me a report right before the show from Apollo, I guess Apollo Investment Management, some really smart folks over there, and they talked about some of the headwinds for economic growth. We touched on some of them. He mentioned tariffs. We touched about on that. I guess retaliation means other countries retaliating. I think we're aware of that. Uncertainty
But,
about
but
trade deals. We
let's
went,
spend real quick, Mike. So
yep.
so we talk about us and paying these tariffs and who's paying them, but what we haven't talked about is that we expect other countries in retaliation to go, hey, well, you're going to tax us, you're going to make us pay tariffs on the stuff we sell you. Guess what? We're going to do the same with products that you sell to us, and in particular. China's been a headline risk on that one, Mike. China's been very aggressive. But think about Mexico and Canada going, hey, wait a minute. You can't just tax our stuff. We're going to tax yours. And again, headline every day. One of these countries is coming back and going, hey, if you do it to us, we're going to do it to you. And there are, again, economic implications of that happening.
But Dom, isn't that a lot of that at this point baked in the cake, kind of?
Well, so I want to go no, but I'm sure some of the experts will argue. Certainly, the idea that it's coming is going to be baked in the cake.
Yeah.
On the other hand, what's the number? What's that
Okay.
number going to be? Right.
Okay.
So
Fair.
if you're trying to sell soybeans to China and China says any soybeans coming out of the US are going to be taxed at 30%, that means our agricultural goods are going to cost 30% more. China go, I'll just buy them from Argentina or I'll buy them from Chile. Instead of buying US beef, I'll buy it from Brazil. I'll buy the beef from Australia. So there's a huge rice shortage. I'm not trying to be funny in Far East, but they won't buy U.S. rice. So there are huge implications to all this stuff.
One of the other things that they mentioned was lower tourism. So I guess, you mentioned earlier the consumer is a little exhausted at this point. I think lower tourism in here implies less foreigners coming into our country to
And
vacation.
we're already seeing that, Mike.
Yeah, I know
Again,
we
this
are.
is
I know
not.
we are.
I mean, we're not trying to be funny when we say stuff like this, but Canadians have been particularly annoyed. Maybe I'm trying to think of a polite word here, Mike, with this administration's reaction, and they've basically created a boycott. They're like, we'll come back when this new president gets elected. And so in general, there's been a significant drop in tourism into the United States. Many of these foreigners do not feel welcome. So they don't come here. And you're like, well, what do we care? Well, when they come here, they spend money. They spend a lot of money, whether it's buying goods, whether it's buying hotel rooms and restaurants and shopping sprees. They spend a lot of money, and vice versa. Many, many, many Americans going, I don't know if I feel welcome traveling overseas. They're choosing to do their travel locally, internally in the United States and not travel abroad. So is already having global implications, Mike.
And I agree with you. I mean, totally agree with you. The other, I'm going to add an 11th headwind, which we really stopped talking about, which I think is important. And I know it's a political hot potato, and it's not a political comment, but why aren't we talking more about these mass deportations? And why aren't we talking about the effect on the job market of deporting people who've been in this country for 10 or 20 years, have actually paid taxes? Yes, they should be here legally. I'm not saying they shouldn't be, but aren't we worried about a drain on the job market, especially lower paying, I hate to say it, lower threshold jobs that, quite frankly, many Americans don't want to do? Why isn't that a headwind on the economy? What am I missing?
Um, Not much. Let's start with that. But I'm going to dissect this into two parts. So
Please.
I don't think it's a coincidence, but the administration, again, I'm not defending them, nor am I making any political
Right.
commentary.
Neither
But
was I.
the administration is focusing more on a criminal element of illegal immigrants. They think that in itself, that's where they should be focusing their resources. And they're not, generally speaking, just picking people up off the street and deporting them, right? But if you have a criminal record, if you convicted of a crime, if you committed a crime, you're top of the list. Unfortunately, some people do get caught up that maybe shouldn't, but the focus has been primarily on the criminal element. And just as a byproduct of what you just said, Mike, they actually are looking to make exceptions, especially in the agricultural manufacturing sector, where, hey, we're not going to come after your workers, we're not going to come after your employees. But again, as long as there's not a criminal element there. So I think the administration is figuring out, hey, we need these workers in this country. Most immigrants are productive people who are just basically trying to raise their family, and they're willing to pay taxes, they're willing to work hard. There are always going to be bad apples, bad actors in this world in general, but in this particular situation. So I don't think it's this mass. We're going to literally, and by the way, it's just practically impossible to take the 16 to 20 million illegal immigrants that the Biden administration let in the country. You can't get 16, 20 million people on a boat or on a plane and ship them out, right?
Right.
So I think the focus and has been twofold. One, get the criminal element out, and then really be restrictive about who does come into the country. And we've seen the numbers of illegals coming into the country literally drop off a cliff. It's just gone to virtually zero.
And look, I obviously agree with you. I don't care if you were born in Guatemala, El Salvador, or Kansas City, Missouri. If you're a criminal, you should not be walking the streets of this country if it could be avoided. Plain and simple. And you're right. More recently, in the last week or two, they have come out and said we are going to make exemptions and exceptions to some of these specific workers because I think they saw the negative effects of these people, being off of the labor roles of these, farmers and factories and in these, middle America companies that these workers were being missed. I think that's why more recently it wasn't the intention to start out, but they realized, as you said, kind of the misgivings of their ways and the unintended consequences they were doing to the economy.
Look, the politics in this are just incredibly ugly, right, Mike? Other countries have figured this out. As complicated as the issue is, they basically give out a work visa. And that allows you to work. It doesn't let you be a citizen. It doesn't let you vote. Doesn't let you collect benefits for life, but it allows you to work legally, pay your taxes legally, and certainly the opportunity maybe somewhere down the road to become a citizen. So the solutions to these issues are not that complex, but the politics are really horrible. And will we ever get to the point where these people can be treated with dignity and respect and they can be value added to our society and our economy? You hope to God so, Mike. We all came, other than the Native American Indians, we all came from immigrants, right?
Everyone's exactly. Everyone's from someplace else. All right, switching gears, another headwind. Um, I think you're old enough to remember Doge. Remember that, right? That's a headwind. And look, I'm not making fun of it. A lot of people were let go, and but they're calling the layoffs of government workers, a real problem. And what I saw over the weekend, a headline over the weekend was, the housing market in D.C. and the surrounding areas are taking a hit because all these people are leaving town.
Um, so again, Democrat, Republican, they all will raise their hand and agree. They will all agree there is a tremendous amount of waste and fraud in.
100%.
I, I mean, let's be honest. I don't know what I want to use a not nice word, but person would say, no, there's no waste and fraud in the government spending and how they spend it. But and with great promise, Doge came in that they were going to discover it and find it and come up with a resolution on how to fix it. Well, I think they were pretty good at finding a lot of it and at least proposing how to fix it. But somehow that's all of a sudden gotten lost in the weeds. Why is it not a priority anymore? And certainly, I think you would agree, Mike, with a scalpel, not with a sledgehammer, right?
Exactly.
Let's find the waste, the fraud, and billions of dollars have been identified. Again, I won't profess to be an expert on this, but certainly they claim they found billions and billions of dollars. Can't we find better use for that money, especially if we're borrowing money to make those payments, right, Mike? But where's it all gone? Why are they working on it? Did they put it on the back burner until this bill gets passed? I don't know, Mike, but all of a sudden it's not as big of a headline as it was. And I would argue it's pretty damn important stuff.
It's really important stuff. So, all right, let's do this. Let's put your crystal ball on, your fortune teller's hat on. Let's talk about, in no particular order, interest rates, inflation, and where we see the market going for the second half of the year. Pick one, you go first.
I was going to say the easiest one, but I don't know if there's any easy ones, right, Mike? But let's talk about interest rates,
I
right?
knew you
Because
were going to pick that one. I knew that's the one you were going with.
I was going to say the easiest one, but I don't know. But look, certainly a number of Fed governors have come out very publicly and said, no, no, we're going to cut interest rates, right? When we're ready, but we are going to cut interest rates this year. And literally in the last couple of days, even Chairman Powell has come out and said, maybe a little dig to this current administration, Mike, we would have already cut interest rates if it wasn't for the uncertainty of tariffs.
That
Um,
came out.
so
That came out tonight before the show. I bet you dinner. There's a 2 a.m. mean tweet from Trump tonight about Powell.
But if we're going to stay at a high level here, Mike, I think, and we certainly have modeled our portfolios, and we will see lower interest rates by year end than today. And not that I need to have a crystal ball that actually works. We've already seen interest rates crest and start to work their way lower. I have to use the word wonky at least once a podcast.
You do. It's
Uh,
not. It's
at the risk of
contractual. You
being a
have
little
to.
wonky, the 10-year Treasury peaked at around 4.7% just a couple of weeks ago, down to 4.5, now at around 4.2, 4.3. It doesn't sound like much, but it clearly is a cresting and lowering. We hope that continues. It's beneficial for the economy, it's beneficial for our portfolios, consumers, businesses. It's good news if we have lower interest rates.
So okay, I'll go second, but I'll make a firmer prediction. I'm gonna go with two cuts, one in the fall and one in December, Christmas interest rate cut. That's what I think. One into summer, early fall, one at the very end of the year.
I'm gonna second you on those. I think they're pretty good calls. I do agree. I certainly don't like the mythology. I'm going to butcher that word, Mike. Their methods, this current administration's method, and the idea of name calling and tweeting at 2 o'clock in the morning. Um, but I think most people would agree that the cracks in the economy are starting to be seen, and the Fed should be a little bit more proactive. So, should they have started already? I think Powell gave you the yes answer. They should have started already, but it's understandable that they want to see and that leads us to number two on your list, Mike. The inflation data has been getting better, not markedly better, but getting a little bit better. And it will more likely than not continue to get better. But until we know the outcome of this and the economic effects of the tariffs, the Fed says, hey, let's wait and see so we don't get caught, on the wrong side of the equation on this one. So we think inflation also continues to improve through the end of the year, but modest improvements, not anywhere near as big as we had hoped for.
Do you so I expect to see a little tick up or inflation not going down in the third quarter and starting to go down in the fourth quarter because I still think we have to wait to see, although the tariff noise has been a lot quieter. I still think businesses, Dom, are in a wait and see mode until actual deals are done. So I do think that we can see a slight shrinking of the economy for the second quarter. You know, the quarter we just ended yesterday, and a little inflation for the second quarter. And then I am very optimistic about the second half of the year if it's a big if the noise kind of stays kind of where it is at the moment.
So just to kind of put the bow on the inflation number, tariffs would raise prices, and
Yeah.
that would be inflationary. The flip side of that is we have energy that is really come down dramatically. Lower fuel prices, energy prices, heating your home, driving a truck, all those costs have dropped and will continue to drop dramatically. We know real estate, which is a big input into the cost, into inflation, those numbers have softened pretty dramatically. And there's not a lot of pressure on wages going higher because the employment numbers have kind of really softened, right? Although there aren't these mass layoffs, there's been enough that people they're not exactly knocking on the door of the boss, go, give me a 10% raise. They're happy if they get a 3% raise. So again, the three big inputs into inflation, all three of them are kind of rolling over and going lower. So higher costs for tariffs, lower costs for these other factors. We should see inflation stabilize, maybe tick slightly higher, but I don't see inflation going dramatically higher, even if tariffs come into the equation. I don't see them going dramatically higher, Mike.
No, I don't see inflation going dramatically higher, but I do think we will see a little bit of a drag on the economy because I see spending slowing down. I just, you hear it everywhere.
Yeah, Mike. So that now we're going to talk GDP and economic growth, and
Yep.
I called it stagflation, and that's got a very specific kind of meaning and kind of horrible meaning for all of us that were around in the 70s and in the 80s. But in this case, it just means that inflation's going to stick around that 2.5% range. It's not dramatically higher, not dramatically lower, but economic growth is going to come, I won't say negative, but maybe flatline to plus or minus zero growth in the third quarter. And for all the reasons you brought up, Mike, businesses aren't really comfortable spending money. Consumers are kind of holding on to their money a little bit tighter. Even the government spending, Mike, government is being very restrictive in their spending, whether it's Doge or trying to be more economically responsible. Tourism, we talked about it, that usually stimulates economic growth. All these things that would make the economy grow are kind of in hold bucket right now. So we don't expect a big number for economic growth in the third quarter.
And you mentioned a word, stagflation. The root of stag is obviously stagnation. You know, some people, many people were alive in the 70s, lived through that. And we haven't really lived through that in 50 years. So I think the idea of that is a little ominous for consumers and in investors because, their memories of stagflation then, Dominic, wasn't it ginormous interest
Oh,
rates?
we had a recession, right? The economy
Yeah,
was not growing; it was negative, right?
yeah,
We had a recession, and some of us forget, but we had inflation at 16, 18%. We're at 2.5 now. Back then, it was 16 to 18%. So, yeah, for some of us that lived through it, those were pretty horrific economic times. No, we don't see anything like that at all in terms
no,
of magnitude.
right.
But again, stagnant growth, we're going to call it plus or minus zero growth with modest inflation that is not really coming down dramatically.
Yep, and I agree with you. But as I said, I am optimistic for the second half of the year. Look, there's always we don't know what we don't know, but we are getting through a lot of these things, and I do have to give Washington some credit. It starts with the administration, it starts with Mike Johnson. I don't know about you, but I am stunned that Congress is dealing with a bill 6 months before it actually expires. When was the last time that happened?
Look, and again, we're keeping politics out of this, but this administration came in with an agenda and their hair on fire, right? We're going at 120 miles an hour, and we're not going to slow down. And it shockingly, because nothing ever happens quickly in Washington.
Right.
And yet, this administration, for a whole bunch of reasons, which I don't think we have enough time to go into tonight, but they came in going, no, we're committed, and this is the agenda. And whether we talk about immigration, whether we talk about trade policy, whether we're going for it. We're going for it at 100 miles an hour, and they are, Mike. So to your point, the idea that we can get into the fourth quarter, if a lot of this stuff, even if it's not resolved in a way that makes us happy or 100% happy, if at least we don't have to worry about it, if at least we can go, okay, we can deal with this. American businesses can figure out we can deal with this, then the future could be really bright.
Dom, what do we always say about the markets? They can handle the good news, they can handle the bad news. They hate uncertainty. And again, not to beat a dead horse, that's where we were with the tariffs. That's why I think spending is down because we are in a period right now of enormous uncertainty. And that's what continues to make me nervous in the short run. But I'm confident it will be resolved long before the year is over. That's why I'm optimistic in the long run.
Yeah, Mike, and we talked about the headwinds, and that's kind of a negative, right? Maybe we take the last couple of minutes and talk about the positives, and
Right.
you brought up some of them, right? We could be looking at way lower energy prices, and that is stimulative to the economy, right? Regulations and it kind of just drives businesses nuts. If we have some clarity on that, that could make businesses more apt to, hey, let's be more productive. We know the number of manufacturing companies that are building plants right now in this country that will be positive to economic growth. God Almighty, we can get past some of this just negative headlines that'll put the consumer in a happier place. The happier the consumer is, the more spending they're going to do. So, I mean, I can go on and on with another half a dozen of these, but there is a positive story that we can weave here, Mike, that it's not completely doom and gloom. It's just we got to get through these headwinds. We got to get through some of these hurdles.
And and I think we will because we normally do. And I think the other part of it, Dom, which we didn't talk about at all, um, AI technology was all the rage for a couple of years. The Magnificent Seven, we haven't talked about that in a while. And that trade, Dominic, is also kind of back in vogue. Beginning of the year, we worried about China and DeepSeek, and all of a sudden, Dom, AI AI's had its day in the sun again. The Magnificent Seven, not all at the same time. They're not all going up, but they've had a
It's
really,
probably
really
it's
nice.
probably the Magnificent Three, to be honest with you, Mike.
Okay, but
Maybe
they've had
three
a
and a half.
they
But AI technology, we're starting to kind of get a handle on what it actually is and what it
right.
could actually do. And unfortunately, this might be bad for jobs, but it will allow companies to operate more efficiently, to operate quicker, faster, at a lower cost. A robot that literally will pick up boxes out of the back of a truck and put them in front of your house, bad for the employee that was working, but good for his back because he's not going to tear his back, tear an ankle, fall, slip, and the robot doesn't go on vacation and or put in for sick leave. Um, so there are huge efficiencies, cost savings coming, and I don't think it's 3 months, but I don't think it's 30 years either, Mike. I think we're looking at a time frame relatively quickly, 3, 5, 10 years, where it will transform our economy. It will transform our world.
Dom, I think the 4-day work week is coming.
Well, again to this point, think of now it's becoming pretty commonplace the self-driving vehicles, the robo taxi that picks you up at your house. Great, it's efficient, it's clean, clean energy. But the guy that used or the woman that used to drive that vehicle no longer has a job. So it's not going to happen in a day, a week, or a month, but it's going to happen. Mike. It's going to happen. And this is where artificial intelligence will transform our economy and our world.
You're right. And I wasn't kidding. I do think the 4-day work week is coming. So I don't know if you want Friday off, Monday off, or Wednesday off, but I do think as the economy becomes more efficient, to your point, robots don't take a day off and robots don't slip a disc and fall off a scaffold. I think it's coming. I do.
Well, I'd be happy if we went from a 60-hour work week, Mike, to a 41. That would be pretty good for you and me. But putting that aside, there is this moral question about laying people off and then having jobs. And the solution so far seems to be okay, instead of working 5 days a week, we're just going to give people 4 days a week. And that allows that extra day for that other person who didn't have a job anymore.
Yeah.
We'll see how we resolve all this, Mike. An aging population, and those people are going to be retired, so they're coming out of the job market. And then think of something like trucking, Mike. Nobody wants to be a truck driver anymore. Let's be honest. Nobody wants to get in a cab, and I shouldn't say nobody, but not many people want to drive across the country. So a truck can do that all by itself without a driver, do it safer, cleaner energy again, and more efficiently, right? So that means that person could do something that could be more productive and or they would enjoy more. So we don't know how picture is going to be, but it will add efficiencies and profits to companies that are incorporating this technology into their businesses.
Look, Dom, I love our guests. I always appreciate their time, but I always enjoy it when you and I get to schmooze for an hour.
Well, look, and I know we're closing, but pretty good first half of the year. And if we can deal with some roller coaster rides, I think we can look at a positive second half of the year. So let's hope for that. Let's keep our fingers crossed and hope for a positive second half. And maybe we get through another year and look forward to 2026.
Well, I don't know about planning on 2026 already, but I just want to get through the second half of this year. But on that note, we are out of time tonight, and we will be back next week with a new edition of the Lebenthal Report. Have a good night, everybody.